The trajectory of Warren Buffett's Berkshire Hathaway, with its emphasis on predictability and consistent returns, stands in clear contrast to that of Tiger Management, the legendary Wall Street fund founded by Julian Robertson. Beginning with $8 million in 1980, Robertson grew this initial investment to more than $22 billion by 1998, with an annual return of 25%, making Tiger Management the second largest firm in the world at that time. However, Tiger was infamous for running high leverages and prioritizing heavy positions in small cap stocks to generate superlative returns, resulting in a rapid downward spiral of investor withdrawals that ended with the fund shuttering in 2000. Despite its infamous history, Tiger's influence is embedded deep in the world of global finance. Robertson, now retired, invests heavily in other hedge funds, primarily those run by former employees of his now defunct firm. These Robertson protégés are known as the Tiger Cubs, and they manage nearly 50 of the world's top hedge funds. Some of these Tiger Cubs have been at the center of recent market dramas. For instance, in March 2021, Bill Hwang, who founded Archegos Capital Management after leaving the Tiger family, set off a storm in the stock market when his firm began liquidating huge positions in Chinese tech stocks, leaving funds, leverage traders, and investment banks with multi-billion-dollar losses. However, before diving further into the long shadow Tiger casts over the markets today, we should first explore how they achieved their dazzling rise to Wall Street dominance. In short, Julian Robertson subscribed to the strategy of global macro investment. In the 80s and early 90s, Robertson accurately predicted that the fall of the Berlin Wall would result in a bull run for the German stock market, and he successfully shorted the Japanese stock market at the peak of its bubble. In 1992, he foresaw the sharp drop in bond market prices across the global north that led to the Great Bond Massacre of 1994. As a result, by the mid-90s, Tiger Management returns began to pick up serious steam. In the early days, Tiger Management made conventional stock investments. In the mid-80s, it pivoted radically to a portfolio of derivative products, including government bonds, currencies, stocks, interest rates, and worldwide options and futures, landing it squarely in the camp of macro hedge funds. It even once attacked the foreign exchange markets together with George Soros' Quantum Fund, making the echoes of 90s currency crisis reverberate across emerging markets. By employing riskier strategies, such as focusing on derivatives and short-selling macro investments, hedge funds can boast substantial returns. However, when the bets go against the fund, the losses can be substantial. Soros and Robertson are no exception. For example, in late 1998, the hedge fund Long-Term Capital Management lost $4.6 billion during the Russian financial crisis because the fund made a bad bet on interest rates. This crisis in confidence in the Russian ruble also generated over $600 million in losses for Tiger. Despite the somewhat limited impact of this loss, it precipitated widespread investor fear. Later that year, the Tiger Fund suffered a far more serious loss of nearly $1 billion on a single day of trading, mainly due to the surge in the Japanese yen against the US dollar. Near the turn of the millennium, most analysts blamed Tiger's problems on the rush to cash in on the internet craze. Like many hedge funds, Tiger Management turned to the stock market after successive debacles wrought by its global macro investment strategy. On the eve of the birth of the internet bubble, the stock price of firms in the technology-based new economy soared, while the value stocks bought by Robertson continued to plummet, in some cases by nearly 50% of its market value within a single month. To make matters worse, the fund continued to stick up to its portfolio diet of so-called old economy stocks, even though investors were pumping billions of dollars into technology stocks. Robertson even shorted the popular technology companies Lucent Tech and Micron Tech. Unsurprisingly, as tech stocks soared, Tiger Management suffered massive losses, and Julian Robertson, a man once viewed as hedge fund royalty, was unceremoniously dethroned. Scrambling to keep pace, in the fourth quarter of 1999, Tiger Management adjusted its strategy to catch up with the new economy stocks it had previously derided and increase its positions in Intel and Dell. Tiger was out of luck. Soon after making these buys, the internet bubble burst and technology stocks plummeted. Robertson's strategy of buy high, sell low had flopped once again. By the end of 1999, Tiger's assets under management had fallen by 19%, suffering a further 13% loss 2 months later in February 2000. Investors grew nervous and they hemorrhaged their assets from Tiger's coffers. Between September 1998 and February 2000, the value of assets under Tiger's management cratered by over $16 billion. By this point, Robertson had no choice but to terminate Tiger's operations. In March 2000, Tiger Management, the prominent investing vehicle that had once frightened central banks, had shut down. While Robertson's investment career had come to an end, his heritage did not. After Tiger Management was liquidated, some of his star employees, dubbed the Tiger Cubs, began to set up their own firms. Tiger alumni founded about 200 funds, large and small, with over $230 billion under management, although many of them have since gone bankrupt. As we have discussed, one of the most infamous of these cubs was Bill Hwang. When Tiger closed its books in 2000, Robertson urged Hwang to start his own outfit and offered to seed it with $25 million. In just a few years, Hwang's first venture, Tiger Asia Fund, was managing assets exceeding $8 billion, with an annualized rate of return of more than 40%. In 2008, Tiger Asia was shorting Volkswagen, AG, and Lehman Brothers, with takeover speculation sending shares soaring. As a result, Hwang had to close his position at a loss and end the year down 23%. By 2009, as the financial crisis convulsed the markets, central banks infused the money supply. In 2012, Tiger Asia Fund's assets had fallen from $8 billion to just $1.2 billion. In April 2010, acting on suspicion that Tiger Fund Asia was engaged in insider trading, the Hong Kong Securities Regulatory Commission sought a court order to prohibit it from trading in the Hong Kong market. Due to regulatory pressures and battered by poor investments, in 2013, Bill Hwang transformed his assets into a new venture, Archegos Capital Management. Through incredibly lucrative stock bets, he dazzled the investing world, parlaying the $100 million left over by Tiger Management Asia into a fortune of nearly $15 billion. This success only intensified Bill Hwang's aggressive investing style. In March 2021, Archegos defaulted on margin calls from several prominent investment banks, with devastating consequences. The Wall Street Journal reported that Hwang lost $8 billion in just 10 days. The spectacular downfalls of Hwang's Archegos Capital Management and Robertson's Tiger Fund are two of the most dramatic failures in modern financial history. The lesson is clear. Whoever you are, or once were, you must still respect the market and manage the risks against the fluctuating macro policy environment. As we have seen with Tiger Management's fall from grace, failing to do so can have irreversible consequences.